What if I told you that being good with money has less to do with how smart you are and more to do with how you behave? It sounds crazy, right? But let me tell you two true stories that perfectly illustrate this. First, meet Ronald Read. Picture a kind-faced, elderly man, someone you might see working as a janitor or a gas station attendant. For decades, that's exactly what he did. He lived a simple, frugal life in a small town in Vermont. He drove a second-hand car and used safety pins to hold his old coat together. To his neighbors, he was just a humble, hard-working guy. But when Ronald passed away at 92, the world was stunned. This quiet janitor had secretly built a fortune of over $8 million. How? By patiently and consistently investing his modest savings into blue-chip stocks for decades, and simply letting time do its magic. Now let's look at Richard Fuscone. He's the complete opposite. A Harvard-educated finance executive from Merrill Lynch, living the high life in a massive mansion in Connecticut with a private jet and a fleet of luxury cars. He was brilliant at the top of his game and earned a fortune advising others on how to manage their money. You'd think he had it all figured out. But in the 2008 financial crisis, it all came crashing down. He had taken on immense debt to fund his lavish lifestyle, and when the market turned, he was wiped out. The man with the Ivy League degree declared bankruptcy. The same year, the humble janitor's wealth was peaking. So what's the lesson here? We have a janitor who became a multimillionaire and a financial genius who went broke. It proves a powerful point from the book The Psychology of Money. Financial success isn't a hard science. It's a soft skill where how you behave is more important than what you know. Ronald Read wasn't a financial expert, but he mastered the behaviors of patience, frugality, and long-term thinking. Richard Fuscone was an expert, but his behavior fueled by greed and overconfidence led to his ruin. This shows that building wealth is available to anyone regardless of your income or education. It's about your mindset. It's about avoiding stupid mistakes more than it is about making brilliant moves. You don't need a fancy degree or a six-figure salary to achieve financial freedom. You just need to be patient and disciplined. It's a simple lesson, but as these two stories show, it's also an incredibly powerful one. Thanks for watching. If you found this story insightful, don't forget to like this video and subscribe for more content that can change the way you think about money. Chapter 1. No one is crazy. Why your financial decisions are not crazy? Why would someone buy a $10 lottery ticket instead of investing in an index fund? Why would a 25-year-old put their life savings into crypto, while a 65-year-old won't even touch stocks? We tend to label these decisions dumb, irrational, or crazy. In Chapter 1 of our Psychology of Money, we explore the book's first and most powerful lesson. No one is crazy. Your financial decisions are not made on a spreadsheet. They are made at the dinner table, in your childhood home, and in the shadow of your own unique personal experiences. This video is the key to understanding your own money habits and everyone else's. Let's be honest. We all think other people are crazy with their money. We see the person in front of us at the convenience store buy $20 in lottery tickets, and we think, they're crazy, they're just throwing money away. We see our parents who refuse to invest in anything but savings and bonds, and we think, they're crazy. They're letting inflation eat their money alive. We see a 22-year-old on TikTok go all in on a new cryptocurrency, and we think, they are definitely crazy. They're gambling their future. We judge, we label. We assume we know the rational path and that they are simply being foolish. But what if we're wrong? Welcome to Chapter 1 of The Psychology of Money. The title of this chapter is the most important foundation for everything that follows. No one is crazy. The core idea, lived experience versus textbook theory. The central idea of this chapter is simple. No one is crazy. Their decisions make perfect sense to them. Why? Because your personal experience with money is 1,000,000 times more powerful than any lesson you learn from a textbook. What you've lived through, who your parents were, where you grew up, the economy you were born into shapes about 80% of your financial beliefs. The data, the spreadsheets, the advice. That's maybe 20%. We're not making decisions on a spreadsheet. We're making them based on the stories we've told ourselves, the fears we have inherited, and the opportunities we have seen with our own eyes. Let's go back to our examples. But this time, let's look through their eyes. Let's look at the person buying the lottery ticket. You see the math, the 1 in 300 million odds. You see a tax on the poor. They see a completely different reality. Their life experience may have taught them that the rational path saving $20 a week is a joke. Their wages are stagnant. An unexpected car repair or a medical bill wipes out their savings every single time. The entire system of 401ks and index funds feels like a private club they were not invited to. For them, saving $20 is pointless. But a $20 lottery ticket? That's not a financial calculation. That is a purchase. They are buying a week's worth of hope. The dream of a way out. Given their life experience, is their decision really crazy? Or is it a perfectly rational response to a system that feels rigged against them? See? No one is crazy. Now let's look at the young crypto investor and their out-of-touch parents. If you were born in, say, 1960, what's the biggest financial event of your life? It might be the 1970s and early 80s when inflation was over 10%. You saw your parents' savings get destroyed. You learned that the only way to build wealth was to beat inflation, so you piled into the stock market's 1980s and 90s bull run. Your experience taught you, stocks always go up. Savings accounts are for suckers. But if you were born in 1995, your formative financial experience was the 2008 crash. You saw the safe investment real estate collapse the entire global economy. You saw your parents lose their jobs. You entered the workforce with massive student debt, stagnant wages, and housing prices that seem like a fantasy. The rational path of just buying an index fund feels slow, boring, and insufficient. Then, you watch people become millionaires on meme stocks and cryptocurrency. So, when the 60-year-old sees crypto, they see insane risk. When the 25-year-old sees crypto, they see opportunity. The 60-year-old is not crazy. The 25-year-old also is not crazy. They are just two rational people, shaped by two completely different worlds, who happen to be living at the same time. This chapter is not just about learning to have empathy for other people. It's about having the humility to understand yourself. It is forcing yourself to accept that your financial worldview, the one you know is right, is just one tiny sliver of reality. Your common sense is just your sense. It is a bias. It's incomplete. And it's based entirely on the unique path you have walked. Accepting this, that your own views are just as biased as everyone else's, is the first and most critical step to making better, wiser, and calmer decisions with your money. But if our decisions are just based on our own experiences, how much of our success is really in our control? What if it's all determined by two forces we can't see? To understand this, author Morgan Housel tells us the story of Bill. We all know Bill Gates. Genius, visionary, hard worker. All true, but Housel points out a detail we almost always ignore. In 1968, when Bill Gates was a teenager, he went to Lakeside School. Lakeside was, almost certainly, the only high school in the entire world that had a time-sharing computer terminal. Think about that. Not 1 in a million. More like 1 in 100 million. Bill Gates, the budding computer genius, just happened to go to the one school on Earth that gave him access to a computer. He couldn't have planned it. His parents didn't know. It was pure dumb luck. But this story has a dark twin. A shadow. Bill Gates had a best friend at Lakeside named Kent Evans. By all accounts, Kent was just as smart as Bill. He was part of that same small computer club. He shared the same passion, the same vision. He and Bill talked for hours about the future they would build together. Kent Evans was poised for the exact same level of success. But before he even graduated high school, Kent went mountaineering and died in an accident. 1 in a million. The exact same force that gave Bill Gates a 1 in a million head start showed up for his best friend as a 1 in a million tragedy. One got the lottery ticket of luck. The other got the lightning strike of risk. This isn't ancient history. This happens every single day. Let's take a modern example that's 100% related. Imagine it's January 2020. On the left, you have Sarah. She's a brilliant chef. She scrimped and saved for 10 years, poured her life savings into her dream restaurant. It's finally profitable. She's a master of her craft, a great boss, and a savvy business owner. Her effort and skill are 10/10. On the right, you have Tom. He's an anonymous software engineer at a small, decent company called Zoom. He's good at his job. He gets his stock options. He's smart, but he's not a visionary. He's just doing his work. Then it happens, a global pandemic. An external risk so massive, so unforeseeable, that it doesn't care how good a chef Sarah is. It doesn't care about her work ethic. Her business is shuttered. Her life savings are wiped out. She's a victim of catastrophic risk, but for Tom, the Zoom engineer, this same event is a lottery ticket. The exact same external force that ruined Sarah makes him a millionaire, maybe a multimillionaire almost overnight. Now ask yourself, did Tom suddenly become 1,000 times smarter? Was Sarah suddenly lazy or bad at her job? No, the invisible hand of luck and risk just swept across the board and picked new winners and losers. So, what's the point? To just give up? To say it's all a lottery and nothing matters? No, that's the wrong lesson. The real lesson Housel makes is this: we are blind to what we can't see. We study success. We read biographies of billionaires like Bill Gates and Jeff Bezos, and we try to copy exactly what they did. But we can't copy their luck. We can't copy going to Lakeside School in 1968. We can't copy starting an online bookstore in 1994. We also study failure. We blame people who go bankrupt. We say they must have made a mistake. But we don't see the invisible risk that hit them. The lesson is to stop studying the extremes. The extremes, the mega billionaires and the catastrophic bankruptcies, are where luck and risk have the most power. Trying to copy them is like trying to copy a lottery winner. Instead, Housel says, study the patterns. What's the broad, replicable pattern for success? It's not start a software company in your garage. It's be a consistent saver. It's stay in the market for a long time. It's avoid catastrophic debt. This is why we need things like an emergency fund. This is why we diversify our investments. We don't build a savings account because we expect a disaster. We build it because we acknowledge the existence of risk we can't predict. A margin of safety isn't just a buffer. It's the only thing that lets you survive the bad luck. Long enough for the good luck to find you. So the next time you see someone achieve wild success, be happy for them. But have the humility to know that luck probably played a role. And more importantly, the next time you fail or see someone else fail, have the compassion to know that risk may have just been doing its job. Luck and risk are two sides of the same coin. They are the reality that the world is far more complex than a simple formula of effort and reward. Acknowledge them, and you're one step closer to mastering the psychology of money. But this brings up a dangerous new question. If you do get lucky, if you do make it, if you build a fortune, whether by luck or skill, how do you keep it? How do you know when to stop? Chapter 3. Never Enough. In our last chapter, we learned that our financial lives are governed by the invisible, unfair forces of luck and risk. But that raises a critical question. What happens when you win? What happens when luck finds you, your skill pays off, and you make it? What do you do then? You'd think the story ends there. You'd think you'd be happy. But you'd be wrong. Because that's when the most dangerous psychological flaw of all kicks in. To understand this, we need to talk about a man named Rajat Gupta. You probably don't know his name. But in the early 2000s, this man was at the absolute peak of the financial world. He was the CEO of McKinsey, the world's most prestigious consulting firm. He sat on the board of directors for Goldman Sachs. He had a net worth of over $100 million. This man didn't just have money. He had prestige. He had power. He had everything. He had enough by any rational definition on earth. And then he threw it all away. In 2008, in the depths of the financial crisis, Warren Buffett decided to make a $5 billion emergency investment in Goldman Sachs. This was secret market-moving news. Rajat Gupta, as a board member, heard this news. Seconds after the board meeting, before the news was public, Gupta hung up and immediately called a hedge fund manager named Raj Rajaratnam. He leaked the information. Rajaratnam's fund instantly bought 175,000 shares of Goldman Sachs. When the news became public, the stock soared. Rajat Gupta, the $100 million man, had just committed insider trading. He was arrested. He was convicted. His reputation was destroyed. He was sent to federal prison. He lost everything. This story is a riddle. Why? Why would a man with $100 million risk his freedom, his family, and his entire reputation? For what? A few million more. He wasn't poor. He wasn't desperate. The money he gained from that illegal trade would not change his life one single bit. But the loss would change it forever. He risked what he had and needed. For what he didn't have and didn't need. Morgan Housel explains this is the psychology of never enough. The problem for people like Gupta is that the goalposts keep moving. He wasn't comparing himself to us. He was a $100 million man, but he was hanging out with $1 billion men. And the billionaires were hanging out with $10 billion men. He was a victim of social comparison. No matter how much you have, you can always find someone who has more. And if you let it, this comparison will drive you to take bigger and stupider risks. You become a hamster on a wheel that you can't get off. This isn't just a 2008 story. This is the exact same story we just saw play out with Sam Bankman-Fried and FTX. Think about it. SBF was worth at his peak over $26 billion. He had it all. He was the face of a new generation of finance. He was advising Congress. He had enough, but it wasn't enough. The goalposts moved. He wanted to be the next Warren Buffett, the world's richest man, the most powerful person on earth, so he allegedly took insane, fraudulent risks with customer money. He risked his entire empire, everything he had and needed, to get even more of what he didn't need. And just like Gupta, it all came crashing down. He lost everything. It is the exact same psychological flaw, just in a different decade. This brings us to the lesson. Rajat Gupta and SBF are extreme examples, but this flaw lives in all of us. It's the feeling you get when you get a raise, and for a week you feel great, until you see your neighbor's new car. It's the feeling of your investments doing well, but then feeling sick because your friend's crypto pick did better. This is the battle you have to win. Morgan Housel writes that the hardest financial skill, harder than finding the right stock, harder than timing the market, is getting the goalpost to stop moving. It's learning to say two words, I'm done, or that's enough. Enough is not a small number. Enough is not giving up. Enough is a fortress. It's the point where you realize that the upside of more is not worth the downside of ruin. It's understanding that the most valuable things, reputation, freedom, family, and happiness, are priceless and are not worth risking for a few more dollars. The only way to win the game of never enough is to refuse to play it. Chapter 4. Confounding compounding. In our last chapter, we saw the dark side of ambition, the dangerous mindset of never enough. We saw how brilliant, hyper-successful men like Rajat Gupta and Sam Bankman-Fried lost everything, their freedom, their reputation, their fortunes, all because they were on a destructive, fast track to get more. They were completely destroyed by greed. So, if that's the fast track to ruin, what's the slow, steady path to unbreakable wealth? What is the single most powerful force in all of finance? It's a force so powerful, Albert Einstein supposedly called it the eighth wonder of the world. It's the real and surprisingly simple secret that actually made Warren Buffett a billionaire. And it's a secret that has almost nothing to do with him being some kind of stock-picking Superman. When we think of Warren Buffett, we think of a financial wizard. We think of a man who reads 500 pages a day, finds secret, undervalued companies, and outsmarts every hedge fund on Wall Street. And yes, he is brilliant. But according to Morgan Housel, that's not his real secret. His real secret is time. Let's look at the numbers because they tell a story our brains can barely believe. As of the book's writing, Buffett's net worth was about $84.5 billion. It's a number so big it's almost meaningless. But let's break it down by when he earned it. Buffett started investing when he was just 10 years old. He's been a serious investor since his 20s. So let me ask you, how much of that $84.5 billion do you think he earned after his 65th birthday? Let that sink in for a moment. 96% of his entire fortune was earned after he qualified for Social Security. His real skill wasn't just being a good investor. It was being a good investor for 75 straight years. His entire life is a testament to this one force. He didn't get rich in his 30s or 40s. He was a millionaire, sure, but he wasn't a billionaire until he was 56. Most of his journey was boring. His secret isn't what he did. It's how long he's been doing it. He just didn't stop. He let the eighth wonder of the world cook. The human brain is not built to understand compounding. Our brains evolved to think in linear terms. If I asked you to calculate 8 plus 8 plus 8 10 times over, you can do it. It's 80. You see the pattern. The growth is steady, predictable, and linear. But if I ask you to calculate 8 times 8 times 8, your brain short circuits. You can't intuitively grasp the answer. That is exponential growth. Let me give you a better, more famous example. If I offered you 2 payment options for a 31-day job, Option A, I will give you $10,000 a day. Or option B, I will give you 1 penny on day 1 and double it every single day. Which do you choose? Most people would take option A. $10,000 a day sounds amazing. After 10 days, you'd have $100,000. The person who chose option B, they'd have just $5.12. They'd look like an idiot. After 20 days, you'd have $200,000. The person with option B would have $5,242. They are still way behind. This is the psychological trap. This is the part where everyone quits. It's what we call the valley of disappointment. It feels like it's not working, but then the magic happens. On day 31, you, with option A, would have a total of $310,000, a great payday. But the person with option B, they would have $10.7 million. That is compounding. The results are always backloaded. The first 10, 20, even 30 years of investing can look boring. They can look linear. You might feel like you're failing. And that is exactly why we get impatient. We jump off the ride to try and find something faster. We try to be Rajat Gupta. We chase the quick win. But the real magic, the real wealth is in the last few days. It's in the last 10 or 20 years of a 50-year journey. And it only goes to those who have the patience to stick around. Let's make this crystal clear. Let's compare Warren Buffett to another legendary investor, Jim Simons. Simons ran a hedge fund called Renaissance Technologies. He is, without question, the most quantitatively brilliant investor of all time. He's a PhD mathematician who hired physicists and codebreakers. While Buffett was earning his good 22% average annual return, Jim Simons was earning an unbelievable, godlike 66% average annual return. He is a 3 times better investor than Buffett. And yet, Jim Simons' net worth is about $23 billion. Warren Buffett's is over $84 billion. How? Why is the guy with the worst returns 3 times richer? The answer is time. Simons didn't find his investing groove until he was 50. He's been doing it for about 30 years. Buffett has been doing it for over 75 years. Buffett's good returns, compounded over a human lifetime, beat Simons' spectacular returns, compounded over a shorter period. The lesson here is this. Good, consistent returns that you can stick with for the longest possible time will always beat high. Spectacular returns that you can't maintain. So what's the lesson for us? The lesson is not to just buy and hold and pray for the best. The lesson is that the most powerful tool you have in your financial arsenal is not your IQ. It's not your spreadsheet. It's not the hot stock tip you got from a friend. It's your patience. It's your endurance. It's about finding a pretty good strategy like investing in broad index funds or buying rental properties, whatever it is for you, and just not interrupting it. It's about letting the 8th wonder of the world do its work for you while you go out and live your life. Stop looking for the highest possible returns. That path is a trap. It's stressful, it's risky, and it leads straight back to that never enough mindset we talked about. Instead, look for the most consistent returns you can get for the longest possible time. That is how you build unbreakable generational wealth. Chapter 5, Getting Wealthy versus Staying Wealthy. In our last chapter, we learned the 8th wonder of the world, compounding. We learned that the secret to building a fortune like Warren Buffett is being a stock-picking Superman. It's about getting good, consistent returns for the longest possible time. Just let time do the rest. Simple, right? But there's a catch. A huge one. The letting time do the rest part is the hardest, most brutal part of the whole equation. Because time is not a smooth, straight line. Time includes recessions. Time includes pandemics. Time includes wars. Time includes you losing your job, getting scared, and panic selling at the very bottom. It turns out getting wealthy and staying wealthy are 2 completely different and opposite skills. Offense versus defense. Think of it like a sports team. Getting wealthy is all offense. It requires optimism. It requires putting yourself out there. It requires taking big risks. You have to be positive, believe in your idea, and have the courage to take the shot. But staying wealthy is all defense. It requires the exact opposite of offense. It requires paranoia. It requires humility. It requires a healthy, constant fear that what you've built can be taken away in an instant. It requires frugality and an acceptance that the future is uncertain. The problem is the mindset that makes you a genius at offense often makes you a fool at defense. And there is no better modern example of this than the story of a man named Bill Hwang. The modern-day Icarus, Bill Hwang, you may not know his name, but in March 2021, Bill Hwang was the talk of Wall Street. He ran a private family fund called Archegos Capital. Bill Hwang was an absolute genius at offense. He was a master at getting rich. Starting with just $200 million, he built one of the world's great fortunes. In a few short years, he parlayed that $200 million into $20 billion. How? All offense. He used a tool called leverage massive amounts of borrowed money. For every $1 he had, he was betting $5, $6, even $8. As long as his stocks went up, he was the smartest man in the world. But he had zero defense. He was all in, all the time. Then, in late March 2021, one of his big bets, a stock called Viacom CBS, started to fall. Just a little bit. This triggered a margin call. The banks that loaned him all that money got scared. They said, "You need to pay us back now." He couldn't. So they started force selling all of his stocks to get their money back. This caused the stocks to fall faster, which triggered more margin calls, which caused more selling. It was a death spiral. In 2 days, the entire $20 billion fortune was gone, evaporated, wiped out to zero. It was one of the fastest and most total destructions of wealth in modern history. Bill Hwang was the best defensive player on the field. But because he never learned to play defense, he didn't just lose the game, he was erased from the league. This is the core of the chapter. We spend all our time studying how to get rich. We study Bill Gates, Elon Musk, and Bill Hwang. We rarely study how to stay rich. But, as Morgan Housel says, if I had to summarize money success in a single word, it's survival. Warren Buffett's partner, Charlie Munger, said it best. The first rule of compounding is to never interrupt it unnecessarily. Getting wiped out to zero is the ultimate interruption. You can't compound zero. This is why staying rich is the more important skill. It requires a total psychological shift. Getting rich needs optimism and risk-taking. Staying rich needs paranoia and a margin of safety. In finance, your margin of safety is cash. It's diversification. It's living below your means. It's the buffer that lets you survive the bad luck and the inevitable market crashes, so that your compounding doesn't get interrupted. It's the defense that lets your offense stay on the field. So, what does this mean for us? It means we need to build a life that is financially unbreakable. Being unbreakable is more important than chasing the highest possible returns. How? 1. Plan on the plan not going to plan. The world is unpredictable. Recessions, pandemics, job losses, they aren't possibilities, they are inevitabilities. You don't know when they'll happen, but you know they will. Have a margin of safety, cash ready for when they do. 2. Avoid ruin at all costs. You must never take a risk that can wipe you out. Never. No investment is so good that it's worth risking everything you have. The person who makes 12% a year but can stick with it for 50 years will destroy the person who makes 100% 1 year and gets wiped out the next. 3. Be optimistically paranoid. This is the balance. You must be optimistic about the long term. The world will grow, the market will eventually go up, but paranoid about the short term. Anything can happen tomorrow. Be an optimist who saves like a pessimist. That is the secret to staying wealthy. Chapter 6. Tails. You win. In our last chapter, we learned that the secret to staying wealthy is survival. It's a defensive, paranoid, don't get wiped out mindset. But that's a contradiction, isn't it? How can you get spectacularly rich if you're so busy just surviving? How can you be paranoid and optimistic at the same time? What if I told you that in finance, in your career, and in life, you can be wrong most of the time? What if I told you that you can fail 80%, 90%, even 99% of the time and still end up spectacularly, unbelievably wealthy? It sounds impossible. But it's the most powerful law in finance. The normal world versus the real world. The first thing we have to understand is that our brains are not built for this concept. We're taught to think in terms of averages. If you have 2 C students and 2 A students, Their average grade is a B if a 7-foot-tall NBA player walks into a bar with 3 5-foot-tall people. The average height is 5 feet 6. In this normal world, nothing is too extreme. This is called a normal distribution. And in most of finance and investing, it is a complete lie. In the real world, the world of money, we don't live on a bell curve. We live in a world of tails. A tail is an extreme 1 in a million event. In a tail world, a few things get all the results, and everything else gets almost nothing. In a tail world, the average is meaningless. If Jeff Bezos walks into that same bar, the average net worth in the room is suddenly $50 billion. The average is now useless, because one tail event, Bezos, is skewing the entire result, and this is how investing actually works. The venture capital secret. The easiest way to understand this is to look at venture capital. VCS are the people who invest in tiny brand new startups, hoping one becomes the next Google or Uber. Let's say a VC firm raises $100 million. They invest that money into 50 different startups. What do you think their batting average is? How many of those 50 companies need to be successful? You think, well, maybe 60%, 70%? The real answer? 1. Here's what actually happens. Of those 50 startups, 30 of them will go to zero. Total failures. Another 10 to 15 will be the living dead. They don't fail, but they don't succeed. They just return the original money, maybe 1 or 2 will be good wins. They double or triple the money, and then there's one. One company, out of 50, goes 10,000x. It's the tail event. It becomes a household name. That one single spectacular winner will pay for all the other 49 failures and produce 99% of the entire fund's profit. The VC's job is not to be right most of the time. Their job is to survive all the small failures long enough to be massively right once. This isn't just for VCS. It's for you. This is the part where you say, okay, but I'm not a venture capitalist. It doesn't matter. This concept applies to your 401k and your stock portfolio. Morgan Housel cites a famous study of the Russell 3000 index, which is basically the entire U.S. stock market. The study looked at all the individual stocks from 1980 to 2014. What did it find? 40% of all stocks were catastrophic failures. They lost almost all their value and never recovered. The majority of stocks were duds. They barely made any money at all. So why does the stock market go up? Because a tiny handful of companies, about 7% of the total, were tail events. These were the Apples, the Amazons, the Microsofts, the Home Depots. These few super performers produced all of the market's gains. The other 93% of companies were, on average, a complete wash. This is the most important investing lesson in the world. When you buy a broad index fund, like the S&P 500, you are not buying the average. You are buying a strategy that guarantees you will own the 7% of tail winners. You are buying the whole haystack. To make sure you get the handful of golden needles that do all the work. The takeaway. How to use this. So, what's the takeaway? This changes everything about how we see success and failure. 1. Failure is normal. Stop fearing it. You are going to be wrong. You will pick stocks that fail. You will start projects that go nowhere. This is not a sign you are a bad investor. It's the cost of admission. It's the price you pay to be in the game long enough to catch a tail. 2. You don't need to be right often. You just need to be right big. You can be wrong, and then right in a way that changes your life. This is why we diversify. We are buying as many lottery tickets as we can, knowing most will be duds, but 1 or 2 will be life-changing. 3. This connects back to Chapter 5, Survival. This is the Grand Slam connection. Your margin of safety ... Your defensive, staying wealthy mindset is what allows you to survive all the 93% of things that don't work. It's the cash on the side that lets you stay invested during the market crashes. The humility that prevents you from going all in on one thing and getting wiped out. Like Bill Hwang. Your defense is what keeps you in the game long enough for your offense, the tails, to finally show up and win it all for you. Chapter 7. Freedom. In our last chapter, we learned that success in investing is a strange game. It's a game of survival. It's a game of being wrong most of the time. It's a game of being patient enough to let the tails, those rare, massive wins, do all the work. It's a lot of paranoia. It's a lot of waiting. It makes you ask a simple, profound question. Why? Why go through all this trouble? Why save? Why invest? Why spend decades playing this game of compounding? Is it for a bigger house? A faster car? A luxury watch? We think that's the goal. We're taught that's the goal. But what if that's all a lie? What if the real prize? The single most valuable thing money can ever buy is something you can't see and you can't touch? The highest form of wealth. Morgan Housel tells a story about his time as a valet at a high-end hotel in Los Angeles. He saw firsthand the toys of the rich. Ferraris, Lamborghinis, Rolls Royces. He remembers a tech executive who would show up in a brand new convertible. And as this executive would roar up to the hotel, Housel, and the other valets wouldn't think, wow, that guy is so cool. I want to be him. They'd think, wow, if I had that car, people would think I'm cool. They didn't care about the driver. They admired the object. This is the great paradox of wealth. We buy the fancy car, the big house, the luxury watch because we want respect and admiration from other people. But other people don't admire us. They just use our stuff as a benchmark for their own desire to be admired. It's a game you can't win. So if stuff doesn't bring you the feeling you're looking for, what does? The answer is freedom. The highest form of wealth is not a number in a bank account. It is the ability to wake up every single morning and say, I can do whatever I want today. The modern day trap, the hustle versus the unseen. Our modern world is a trap. It's a trap of visible wealth. We are taught to chase the highest possible salary. We become the investment banker, the corporate lawyer, the high-powered consultant. We make $500,000 a year, but we have zero control over our lives. Our boss owns our time. We work 80 hours a week. We're on call 24/7, so we miss holidays. We miss our kids' birthdays. We look rich. We have the car, the house, the title. But we have no freedom. Now, meet a different person. This person makes $100,000 a year. But for the last 10 years, they've saved 25% of their income. They have built a margin of safety. They have built FU money. One day, their boss asks them to work on a weekend or take on a project they hate. This person has the power to say, no. They have the power to take a 6-month sabbatical between jobs without panicking. They have the power to take a lower-paying job that they find more fulfilling because their savings cover the gap. They might not look as rich as the lawyer, but they are infinitely wealthier because they own their time. The ultimate dividend. This is the core of the book. This is the why. The purpose of money is not to buy stuff. The purpose of money is to buy control. Control over your time is the only thing that will reliably make you happier. The ability to do what you want, when you want, with who you want, for as long as you want is priceless. It's the highest dividend money will ever pay. When you have that freedom, you are unbreakable. You're not forced to take a bad job because you're desperate for a paycheck. You're not trapped in a career you hate. You're not terrified of a small emergency because your savings give you a buffer. You're not a slave to your boss or your bank or your own ego. This is the goal. Not a Ferrari. Not a mansion. Freedom. Chapter 8. The Man in the Car Paradox. In our last chapter, we landed on a powerful idea. The highest form of wealth, the ultimate goal is freedom. It's the ability to control your time. And we learned that buying stuff like a fancy car to get respect from others is a paradox, because people don't admire you, they just admire the car. But that raises the next logical question. If the guy in the Ferrari isn't the one we should admire, then who is? What is the real difference between being rich and being wealthy? Because we get them confused all the time. And that confusion is what keeps most people from ever building real wealth. Morgan Housel, the author, tells a story about being a young valet at a luxury hotel. He saw an endless parade of high-end cars. Ferraris, Lamborghinis, Rolls Royces. And he noticed a funny thing. When a guy would roar up in a $300,000 Ferrari, the valets wouldn't think, wow, that guy is so cool. I want to be him. Instead, they'd think, wow, if I had that car, people would think I'm so cool. Do you see the difference? They didn't care about the driver. They didn't even see the driver. They just saw the object and used it as a symbol for their own desire for respect and admiration. This is the man in the car paradox. When we think about buying a fancy car, we imagine ourselves driving it. And we imagine everyone else looking at us thinking, wow, that person is successful. They're amazing. But when we see someone else driving that same car, we don't think about the driver at all. We just think, I wish I had that car. We use other people's visible possessions as a benchmark for our own desires, completely ignoring the person who owns them. The respect you are trying to buy with that car is a mirage. It's an illusion. This paradox reveals the single most important distinction in personal finance: the difference between rich and wealthy. Being rich is visible. Rich is your current income. It's a number. A high-income doctor or lawyer who spends every dollar they make is rich. Rich is the person who has to spend money to show you they have it. Rich is the man in the Ferrari. We can see rich, but wealth is invisible. Wealth is the money you haven't spent. Wealth is the car you didn't buy. Wealth is the designer watch you passed on. Wealth is the financial assets in your account, the stocks, the bonds, the savings that you kept instead of spending. Wealth is what you don't see. Wealth isn't a paycheck. Wealth is freedom. Wealth is flexibility. Wealth is the option to quit your job, take a year off, or retire early because you have a pile of assets working for you. Here is the great deception that traps us. The world is full of people who look rich, but are not wealthy. Remember Richard Fuscone from our introduction? The Harvard-educated exec with the 11-bathroom mansion? He was rich. He looked like a god. But he was so deep in debt he had no wealth. And the 2008 crash wiped him out completely. Remember Ronald Read, the janitor? He looked like the opposite of rich. He drove a used Toyota, but he was secretly wealthy. He had $8 million saved and compounded. He had total freedom. The problem is we are trained to admire the visible, the rich person, but we cannot see the invisible, the wealthy person. So we try to look wealthy by acting rich. We buy the big house, we finance the new car, we buy the stuff. But the very act of spending that money is the exact thing that prevents us from ever becoming wealthy. Every dollar you spend on looking rich today is a dollar that cannot compound for you tomorrow. So, what's the lesson? It's simple, but it's hard. Stop trying to look rich. Focus on becoming wealthy. The respect and admiration you're trying to buy with a fancy car is a mirage. People are just admiring the car. If you want real respect, be kind, be humble, be patient. If you want real wealth, build your invisible assets. Build your savings. Build your investments. Build your freedom. Because that is the only thing that matters. Wealth is not what you show off. It's the security and control you have when no one is looking. Chapter 9. Wealth is what you don't see. In our last chapter, we talked about the man in the car paradox. We saw how we admire the person driving the Ferrari, not because of the person, but because of the car. We imagine ourselves in their place. This revealed a huge truth. What we call rich is just the visible part of money. It's the fancy car, the huge house, the designer clothes, it's loud, it's what you see. But wealth is different. Wealth is what you don't see. It's the money that hasn't been spent. It's the stocks, the bonds, the real estate, the cash sitting in an account that's earning interest. It's the foundation for freedom and options. This brings up a really tough practical problem. How do you build something you can't see? How do you stay motivated to pile up invisible assets when the entire world is constantly screaming at you to buy visible things? You've probably been told the answer is to just earn more money or to find the next big stock that's going to explode. But that's not the real answer. The real answer is much simpler, a bit boring, and the most powerful law of money. There's a great misunderstanding about how wealth is actually built. Most people think the formula is just wealth equals income. If you have a big paycheck, you're wealthy. This is exactly what the rich person we talked about last time believes. But it's fundamentally wrong. Then we get a little smarter. We start to think the formula is wealth equals income minus what you spend. This is getting closer, but it still misses the most important element, the human psychology behind it. Morgan Housel gives us the real formula, the one that truly matters. He says wealth is the gap between your ego and your income. Think about that for a second. Your income is just a number. Your ego is what drives your desires. It's your ego that makes you want to keep up with your neighbors. It's your ego that makes you want that fancy car we just talked about. Your ego is the engine behind that feeling of never enough that we explored in a previous chapter. Here's how it plays out in real life. When you get a raise, your income goes up. Fantastic. But for most people, their ego inflates right along with it. This is what we call lifestyle creep. You make $60,000 a year, you spend $60,000 a year. Then you get a promotion and start making $120,000. So what happens? You start spending $120,000. Your income literally doubled, but your wealth is still zero. Why? Because there's no gap between your ego and your income. They rose together. True wealth is created by widening that gap. Wealth is the invisible money that you manage not to spend. It's the result of non-action. It's the expensive watch you didn't buy. It's the bigger house you decided you didn't need. It's the first-class ticket you passed on. Wealth is literally what you don't see. And this leads us to the most empowering idea in personal finance. Building wealth really comes down to just three things: your income, your investment returns, and your savings rate. Now let's break these down and see which ones you can actually control. First, your income. Can you control it? Well, sort of. You can work hard, learn new skills, and ask for a raise. But you can't control a recession that leads to layoffs. You can't control getting a difficult boss who overlooks you. You can't control your entire industry being disrupted by new technology. Your income is partially in your control, but it's also heavily subject to luck and outside forces. Second, your investment returns. Can you control those? Absolutely not. You have zero control over the stock market's daily swings. You can't predict when the next major market crash will happen. You can't control geopolitical events or interest rate changes. You can make educated guesses, but you can't control the outcome. So that leaves us with the third one, your savings rate. Can you control your savings rate? Yes, 100%. Your savings rate, the percentage of your income that you choose not to spend, is the one and only lever in your financial life that you have complete and total control over. Every single day. Let's look at an example. A person who earns $50,000 a year and manages to save 20% of their income is putting away $10,000 a year. Now, compare that to a lawyer who earns $300,000 a year but only saves 2%. They're only putting away $6,000. The person earning far less is actually building wealth faster. We spend so much time and energy stressing about how to squeeze an extra 1% return out of the stock market. But we could just increase our savings rate by 1%. That move is 100% guaranteed to work, and mathematically, it has the exact same impact on your bottom line. It's the most direct path to building wealth. So if it's this simple, why doesn't everyone just do it? Why is it so hard? It's because we're wired to think of saving as an act of deprivation. We see frugality as a punishment. We think it means we have to give up things we enjoy. But Housel encouraged us to reframe this completely. Learning to be happy with less is a financial superpower. Learning to find joy without needing the latest gadget, learning to be content driving a reliable older car, learning to feel at home in a smaller house, that is the single most powerful financial skill you can ever develop. It's a form of defense against that dangerous never enough trap. It's the key that unlocks the magic of compounding. Because when you can be genuinely happy with less, you break the cycle of lifestyle creep. You stop your ego from growing every time your income does. You create that all-important gap. And that gap, that invisible pile of money you didn't spend, is what becomes wealth. So what's the big takeaway from all of this? It's that wealth isn't built in complex spreadsheets or by chasing hot stock tips. It's built in your living room, in your garage, and most importantly, in your mind. It's found in the non-action of not buying that thing you thought you wanted. Every single time you resist the urge to spend money to look rich, you are taking a concrete, tangible step toward actually becoming wealthy. So, I encourage you to shift your focus. Stop worrying so much about your income or your investment returns. You can influence them, but you can't control them. Instead, pour your energy into the one thing you have absolute control over, your savings rate. That is the foundation of everything. That's the only part of the financial equation that is 100% up to you. Remember, wealth is what you don't see. And the only way to build it is by mastering the art of not spending. Chapter 10. Save money. In our last chapter, we established the single most important, Unbreakable law of personal finance. True wealth is what you don't see. We learned that getting rich isn't about having a huge income or picking the next hot stock. It's about taming your ego and creating a gap between what you earn and what you spend. Out of everything in the complex world of money, the one thing you have 100% control over is your savings rate. Okay, that sounds simple enough. We have to save, but why? From the moment we start thinking about money, we're told you have to save for something. You have to save for a down payment on a house. You have to save for a new car. You have to save for retirement. But what happens when you don't have a specific goal? What if your car runs just fine? What if retirement feels like a million years away? Why should you save money right now? It honestly just feels like a sacrifice. It feels like you're giving up happiness and fun today for some vague, unknown, and distant tomorrow, and that's a really tough trade to make. This leads us to the big myth of saving for. The most common financial advice tells you to have a specific reason for every single dollar you set aside. But the author Morgan Housel argues this is a trap. Why? Because life is not a spreadsheet. Think about what your life was like 10 years ago. Now think about what you thought your life would be like today 10 years ago. Are they the same? Probably not even close. In the next decade, you will want different things. Your career will change in ways you can't imagine. Your relationships will evolve. The world itself will change dramatically. Remember a few chapters back when we talked about luck and risk? And how our lives are often defined by unpredictable, extreme events we call tales? You can't plan for a global pandemic to shut down the world. You can't plan for your entire industry to be disrupted by a new technology. You can't plan for your company to suddenly go bankrupt. You can't plan for your car to die the exact same week your kid breaks their arm and you have a huge medical bill. None of these things are on your 5-year plan. They're not on your vision board. And that right there is the most important reason to save. You don't just save for the things you want to buy. You save for the events you can never predict. So what is the ultimate purpose of saving? It's not about deferring happiness into the future. It's about buying something absolutely essential, right here, right now, today. And what does saving buy you? 3 things: flexibility, options, and control. Let's do a thought experiment. Think about a person with 0 savings. What does their life look like? They are a prisoner to their boss. They can't quit their job, even if it's miserable and soul-crushing, because they absolutely need that next paycheck just to survive. They are terrified of a recession. A single job loss doesn't just mean a tough month, it means total ruin. A simple $500 car repair isn't an annoyance. It's a life-altering crisis. They're forced to go into high-interest credit card debt, which just digs the hole deeper and deeper. This person has no flexibility. They have no options. They have no control over their own life. They are reacting, not choosing. Now, let's think about another person. This person has saved up 6, maybe 12 months of their living expenses. They've built what we called a margin of safety. What does their life look like today? When a fantastic new career opportunity pops up in another city, they can actually consider it. They can take that risk without panicking about how they'll cover rent during the move. When their car breaks down, it's frustrating, sure, but it's not a financial disaster. They just pay for the repair and move on. When their entire industry hits a downturn and layoffs are happening, they can survive for a year without being forced to sell their investments at the absolute worst possible time at the bottom of the market. They have the ability to wait for a good opportunity, instead of being forced to grab the first, desperate one that comes along. That is the purpose of saving. It's not for a new TV or a fancy vacation. It's the ultimate insurance policy against a world that is, by its very nature, unpredictable and chaotic. Saving buys you freedom from fear. This brings up an argument you'll hear from a lot of financial experts. They look at cash in a savings account and say, "Don't just let your cash sit there. It's losing money to inflation every single year. You should have 0 cash and be fully invested at all times to maximize your returns." This advice is perfectly rational. But, as we're going to learn in the next chapter, it's not at all reasonable. Yes, it's true. The cash in your savings account is probably losing 2 or 3% of its purchasing power to inflation each year. It feels unproductive. But what that cash buys you is priceless. It buys you the ability to never ever be forced to sell your stocks in a panic during a market crash. It buys you the psychological strength to let your long-term investments do their thing, to let that compounding machine we talked about work its magic uninterrupted. It buys you the ability to survive long enough for those positive tail events to work in your favor. That unproductive cash is secretly the most productive tool in your entire financial portfolio. It's the psychological buffer that protects all your other assets. It's the shock absorber that lets you sleep at night when the world feels like it's falling apart. Trying to squeeze every last percentage point of return by staying fully invested with no cash buffer is like driving a car with no brakes to get somewhere a little bit faster. It works until it doesn't, and when it doesn't, the crash is catastrophic. So, what's the big takeaway from all this? Stop thinking that you need a specific, tangible reason to save every dollar. You don't. Saving is the reason. The goal itself is just to save. The goal is to build up your invisible wealth until you reach a point where your daily life is decoupled from your next paycheck. The goal is to build enough flexibility to ride out any storm life throws at you, big or small. A high savings rate is the ultimate margin of safety. It's the one variable you can truly control. And it's the only thing that gives you real, tangible freedom and control over your life, not in some distant future, but right here today. Thanks so much for watching. If this gave you a new perspective on saving, hit that like button and be sure to subscribe so you don't miss our next chapter. See you then. Chapter 11. Reasonable is greater than rational. About saving money just for the sake of saving it. About holding on to cash even if it's unproductive, just to have a buffer against the chaos of life. Now, a purely rational, numbers-obsessed economist would say that's dumb. They'd pull up a spreadsheet and prove with perfect math that you're losing money to inflation and that it's not an optimal strategy. They'd insist you must be 100% invested at all times. And technically, on paper, they'd be correct. But they would be missing the most important point of all. You are not a spreadsheet. You are a person. You're a human being who gets scared, gets tired, gets stressed, and doesn't want to live in a state of constant, nail-biting optimization. In the world of finance, what is smart on paper is often terrible in real life. There is a huge critical difference between being rational and being reasonable. And confusing the two is a direct path to failure and regret. So let's define our terms. To be rational is to think like a spreadsheet. It's making every single decision based on cold, hard math and historical data, with absolutely no room for emotion. A rational person knows that historically, the stock market has always recovered from every downturn. Therefore, the rational decision is to be 100% invested, all the time and never ever sell. A rational person would never hold cash because it mathematically loses value to inflation. But to be reasonable is to be human. It's to acknowledge that while the math is important, our emotions are often far more powerful. A reasonable person knows that a 50% market crash feels like the end of the world, even if history says it's not. A reasonable person knows they need to be able to sleep at night without panicking about their life savings. A reasonable person creates a financial plan that is good enough, and most importantly, a plan they can actually stick with when things get terrifying. The rational investor is playing a game of numbers. The reasonable investor is playing a game of survival and peace of mind. Let's see how this actually plays out in the real world. Imagine it's 2007. We have two investors. Investor one is Rational Rob. Rob has studied all the historical data. He knows stocks are the best long-term bet, so his portfolio is 100% in stocks. His friends think he's a genius. Investor 2 is Reasonable Susan. Susan knows stocks are good for the long run, but she's also a bit cautious. She wants a buffer, a cushion just in case things go wrong. So her portfolio is 60% stocks and 40% in less volatile bonds and cash. Her rational friends tell her she's being too conservative and leaving money on the table. Then, the 2008 financial crisis happens. The market falls 50%. Rational Rob's portfolio also falls 50%. His $1 million is suddenly worth only $500,000. He is in agony, he can't sleep. The data says hold, but his gut is screaming sell. This time is different. He finally can't take the pain anymore. He sells everything at the very bottom of the market, locking in a catastrophic, life-altering loss. Now let's look at Reasonable Susan. Her more balanced portfolio only falls about 25%. Her $1 million is now worth $750,000. It's painful, yes, but it's not ruinous. Her bonds and cash acted as a shock absorber. It's scary, but it's survivable. She's not happy, but she's not panicking, so she does nothing. She sticks with her reasonable plan. When the market began its long recovery in 2009, Susan's portfolio recovered right along with it. But Rob, who sold at the bottom, was too terrified to get back in. He sat on the sidelines in cash, watching the market climb higher and higher, missing the entire recovery. So who really won? The reasonable investor with the supposedly suboptimal plan absolutely crushed the rational investor with the perfect plan. Why? Because the best financial plan in the world is completely useless if you can't stick with it when it matters most. This chapter is about giving you permission. Permission to not be a perfect, rational robot. Permission to be a reasonable human. This is exactly why we hold an emergency fund. Is it rational to have $20,000 in a savings account earning 0.5% while inflation is at 3%? No, a spreadsheet says you're losing money every day. But is it reasonable? Absolutely yes. Because that $20,000 isn't an investment. It's an insurance policy. It's the fee you pay to guarantee that you will never have to go into debt or panic sell your real investments when your car breaks down or you have an unexpected medical bill. It buys you peace of mind. This is also why some people choose to pay off their mortgage early. Is it rational to pay off a 3% mortgage when you could rationally expect to get an 8% return in the stock market? No, a spreadsheet would say that's a dumb financial move. But is it reasonable? 100%. Because the psychological value of being completely debt-free, the freedom and security that comes from knowing you own your home outright, is worth infinitely more to some people than that potential 5% difference in returns. The goal of money isn't just to have the highest possible number on a spreadsheet at the end of your life. The goal is to use money to build a good life along the way. The goal is to sleep at night. So be reasonable, not rational. Build a plan that works for you as a human, not one that only works in theory. That's the real secret to winning with money. Chapter 12, Surprise. In our last chapter, we talked about why being a reasonable human is a much better strategy than trying to be a rational spreadsheet. We saw how so-called rational investors, who base every single decision on historical data, often end up failing because their own emotions get in the way. But this raises an even scarier question. What if their data is just wrong? Rational investors live their lives by looking in the rearview mirror. They use history as a map for the future. But what if history is actually a terrible guide? What if the biggest, most impactful events that will shape our financial lives are things that have never, ever happened before? We all have this deep-seated psychological bias called the end of history illusion. It's the belief that while we've changed a lot in the past, right now, in this moment, we're the finished product. We extend this to the world around us. We study 100 years of stock market data, find the average return, and then we build a financial plan that assumes the next 100 years will look exactly like the last 100. This is a catastrophic mistake. Why? Because history isn't just a smooth, repeating cycle. History is a story, and it's a story defined by one thing: surprise. The core idea from Morgan Housel is this: the most important events, the ones that will truly move the needle for your finances, will always be the things you didn't see coming. Just think about the last 100 years or so. Back in 1900, did any financial model on Earth predict 2 world wars? In 1928, just before the crash, did anyone's rational spreadsheet account for a Great Depression so deep and so long that it would last for a decade? In 1995, did anyone really predict a digital dot-com bubble that would completely rewrite the global economy? And let's be honest, in 2019, did a single person on this planet have global pandemic shuts down entire planet for 2 years written into their financial plan? Of course not. These events weren't just unlikely. They were unimaginable beforehand. And yet, after they happened, we look back and we pretend they were obvious all along. This is the big problem with using history as our only guide. It teaches us valuable lessons, for sure, but it can never show us the surprises that are waiting just around the corner. This idea has a famous name: a black swan event. The story goes that for thousands of years, people in the old world believed as an absolute 100% rational fact that all swans were white. Why? Because every swan they had ever seen in all of recorded history was white. It was settled science. Then explorers landed in Australia, and what did they see? A black swan. In an instant, a single observation shattered thousands of years of historical data. The black swan is a powerful metaphor for an event that has three key qualities. First, it is a complete and total surprise. It's outside of all historical experience. Second, it has a massive, game-changing impact like a pandemic or the invention of the internet. And third, after it happens, we all invent stories and explanations to make it seem like it was predictable all along. We call this hindsight bias. The financial world, more than almost any other, is a world of black swans, and this isn't just some dusty old history lesson. Let's talk about right now. We are living through what is potentially the biggest black swan event of our lifetime. The rise of generative AI. Seriously, go back just a few years to 2021. Was the idea that AI will be able to write entire novels, create photorealistic art, and pass the bar exam in anyone's 5-year plan? Was it in the business model for Google? For Hollywood? For our universities? No, it was a complete surprise. And now it is a massive, world-changing event. It will create trillions of dollars in new wealth, and it will destroy trillions of dollars in old industries. Your financial future, your career, your investments, they will be more shaped by this one surprise than by the last 50 years of average stock market returns combined. This is exactly why rational investing, based only on the past, is so incredibly dangerous. The future is not a copy of the past. The future is a story that hasn't been written yet. So if we can't predict the future, if the biggest events are always total surprises, what are we supposed to do? Just give up and hide under a rock? No, this is where everything we've talked about in previous chapters finally clicks together. You have to stop trying to be rational, which means perfectly predicting the future, and you start being reasonable, which means preparing to survive whatever the future throws at you. How do you do that? First, you build a margin of safety. You assume the future will be chaotic. You assume surprises are coming. So you build a financial fortress around yourself. You have cash savings ready to go. You build a financially unbreakable life so that when a bad surprise hits, like a sudden job loss, you can survive it without panicking. Second, you don't bet on the tails. You just wait for them. You accept that you can't predict the next Apple or the next big AI winner, so you don't go all in on one specific thing. You diversify. You buy the whole haystack, like a broad index fund, to guarantee that you'll own the good surprises, the massive winners when they inevitably appear. And third, you stop listening to specific predictions. I'm serious. Nobody knows what the market will do next year. Nobody. The next time you see an expert on TV telling you exactly where the S&P 500 will be in 12 months, just turn them off. They're not a prophet. They're a salesperson. The real takeaway here is humility. We have to accept that the future is a mystery. The best we can do is prepare for a wide range of outcomes, not just the average one we see in the history books. Prepare for surprise because it's the only thing that's guaranteed. Chapter 13. Room for Error. In our last chapter, we discovered a pretty unsettling truth. The future is a minefield of surprises. The biggest, most world-changing events, what we call black swans, are, by their very nature, things we simply cannot predict. This led us to a terrifying conclusion. The biggest risk in your financial life isn't just some random event out there in the world. It's the person staring back at you in the mirror. It's us. You and me. We are deeply flawed planners. We're wired for over-optimism. We're riddled with biases we don't even see. We build these neat, tidy financial plans based on the world we wish existed. Not the chaotic, messy, unpredictable world that actually is. So if we know we're flawed planners and we know the future is a complete mystery, how in the world do we ever build a financial plan that actually works? How do we plan for a future we can't possibly know? The secret, it turns out, comes from a totally different field, engineering. Let's imagine for a second that we're building a bridge. An engineer does all the calculations, they run the models, and they determine that the absolute maximum, Worst case scenario amount of traffic the bridge will ever need to hold is 10,000 tons. So, what do? Do they design a bridge that can hold exactly 10,001 tons? Of course not. That would be completely insane. It would be reckless. Instead, they build a bridge that can hold 30,000 tons. That extra 20,000 ton gap, that massive, seemingly inefficient buffer. That is the room for error. And this is the critical part. It's not there to solve a specific, known problem. It's there for all the problems the engineer cannot possibly imagine. Maybe a once-in-a-thousand-year flood put stresses on the supports they never modeled. Maybe some of the construction materials had a tiny hidden flaw that weakens the structure over time. Maybe the traffic load is 10% higher than they calculated at the exact same moment a high wind storm hits. The engineer can't predict these specific events. They don't know what's coming. The room for error isn't pessimism. It's not the engineer being a downer, it's humility. It's the engineer admitting, I am smart, I have done my homework, but I am not God, I cannot predict everything. This humble acknowledgement of the unknown is precisely how we must approach building our financial lives. It's the only way to build something that lasts. So let's contrast that with how most of us approach our finances. What does a financial plan look like for the average person? It's usually a spreadsheet, right? A neat grid of numbers and projections. And that spreadsheet has a single fatal flaw. It's a straight line pointing up and to the right. We sit down and we plan on getting an 8% return from the stock market every single year for the next 40 years like clockwork. We plan on never losing our job, or at least not for very long. We plan on never having a major medical emergency that insurance doesn't fully cover. We plan on our car never breaking down at the worst possible time. In short, our spreadsheets plan for a world with no surprises. But what is reality? Reality is a chaotic, jagged, unpredictable mess. Room for error is the gap you must intentionally create between your neat spreadsheet plan and the messy chaos of reality. It's the sober acceptance that average returns are a statistical illusion. The average return of the S&P 500 might be 8% over the long run, but it almost never actually returns 8% in any given year. It gets to that average by being up 25% one year, down 18% the next, up 7% after that. It's a roller coaster. Room for error is the financial padding that lets you survive that brutal, gut-wrenching minus 18% year without panicking, without selling at the bottom, and without blowing up your entire 40-year plan. It is the margin of safety that keeps you in the game when reality inevitably deviates from your spreadsheet. Now, if building in this buffer is so obviously smart, why is it so hard for us to do? Why don't more people do it? The simple answer is, it feels wrong. It feels unoptimized. It feels inefficient. And this brings us back to a core idea we've talked about before. The battle between being rational and being reasonable. A purely rational robot, a financial Vulcan, would look at your plan and say, you must be 100% invested in the market at all times, holding cash as a guaranteed loss to inflation. Every dollar must be working for you. The rational robot would say, the spreadsheet shows you only need exactly $1 million to retire. Therefore, aiming for $1.1 million is an inefficient use of your capital. But room for error isn't about being efficient. It's about being unbreakable. It's about endurance. Think about it this way. Maximum efficiency is fragile. A system optimized to 100% has no slack, no buffer. It shatters at the first unexpected shock. A finely tuned race car is incredibly efficient, but a single pothole can end its race. Endurance, on the other hand, is robust. A four-wheel drive truck isn't as efficient on a perfect racetrack, but it can handle the potholes, the mud, the surprises. It survives. And in the long marathon game of investing and building wealth, endurance always beats short-term efficiency. The goal isn't to have the most perfectly optimized quarter or year. The goal is to still be standing at the finish line in 30 or 40 years. So what does this actually look like in real life? How do we apply this concept? Room for error is the ultimate financial defense. It's the practical application of humility. And let's be clear, this is not just about your 6-month emergency fund. That's a good start, but an emergency fund is a specific buffer for a specific predictable problem like losing your job. Room for error is different. It's a general, non-specific buffer for all the problems you can't even name yet. The unknown unknowns. It looks like this in practice. Let's say you run the numbers and you think you need $1 million to retire comfortably. Building in room for error means you aim for $1.5 million instead. That extra $500,000 isn't for anything specific. It's your buffer against a future that might be more expensive or less generous than you hope. Or maybe you think your investments will return 7% a year on average. To build in room for error, you base your entire plan, all your savings goals, on a much more conservative 5% return. If you get more, fantastic. But your plan's survival doesn't depend on it. You think your monthly expenses in retirement will be around $4,000? Do you see the pattern? It's about intentionally underestimating what the future will give you and intentionally overestimating what the future will take from you. It feels conservative. It feels like you're sandbagging. But this deep-seated conservatism is the only way to build a plan that can actually survive contact with the real world. This buffer is what allows the magic of compounding, which we talked about in Chapter 4, to work its magic uninterrupted for decades. It's what prevents you from having to sell your assets at the worst possible time, which is the cardinal sin of investing. And ultimately, creating this room for error is the only way to guarantee that you can stay in the game long enough for those incredible, wealth-creating tales, those rare, outsized positive events we covered in Chapter 6, to show up and change your life. It's not about predicting the future. It's about building a plan that doesn't require you to. It's about surviving. And in the game of money, survival is the foundation of success. Thanks so much for watching. Chapter 14, You Will Change. So we did it. We built the perfect plan. It's got a massive room for error. It's designed to survive whatever the world throws at it, and even survive our own mistakes. We are set, right? Well, there's one final giant surprise we haven't accounted for. We've built a plan for the person we are today. But what about the person you'll be in 10 years or 20? You're going to change. Your goals will change. What makes you happy today might not make you happy tomorrow. And we are terrible at predicting this. There's a powerful psychological bias we all share called the end of history illusion. It works like this. Think back to who you were 10 years ago. Your taste in music, the clothes you wore, your career ambitions, your beliefs about the world. You've changed so much, right? You've grown, you've learned, you've evolved. Now think about the person you'll be 10 years from now. Strangely, our brain just imagines, well, us. A little older, maybe a little wiser, but with the exact same goals, desires, and values. This is the illusion. We see our past as this dramatic story of evolution, but we see our future as a story of arrival. We think, okay, this is it. This is the real me. I've finally figured myself out. I won't change much more from here. As Morgan Housel puts it, we are all walking, talking, end-of-history illusions. And this illusion is one of the most dangerous, most destructive forces in long-term financial planning. Why is this so dangerous? Because we build these rigid 40-year plans for a future person we don't even know. Let's take an example. Meet 22-year-old Alex. Alex just graduated, is super smart, super ambitious. Alex's goal is one word: success. So Alex decides to become a high-powered corporate lawyer. The 80-hour work weeks, the intense stress, the golden handcuffs, Alex is all in. And Alex builds a financial plan to match this life. A $1.5 million condo in the city with a huge mortgage. Alex's entire life, every dollar, is structured for this single, high-stakes path. Now let's fast forward and meet 35-year-old Alex, the person 22-year-old Alex became. 35-year-old Alex has a family. And 35-year-old Alex hates being a lawyer. The condo in the city feels like a cage. All Alex wants now is time. Time to move to the suburbs, coach the kids' sports teams, maybe even teach history. All Alex wants is freedom. But Alex is trapped. Trapped by a rigid financial plan that 22-year-old Alex built. Trapped by that massive mortgage, that high-status career, and those golden handcuffs. This is the moment of crisis. This is when people panic. They feel so stuck that they blow up their entire lives. They sell the condo at a huge loss. They quit their job with no backup plan. They cash out their entire $401k just to feel a moment of freedom. The perfect, rational plan caused the financial failure. Why? because the plan wasn't built for a human being. It was built for a statue, so what's the solution? Do we just not have goals? No, of course not. The solution is to avoid these extreme all-or-nothing plans. The solution is to plan on the fact that you will change. First, you have to value flexibility above everything else. When you're about to make a big financial decision, ask yourself this one question: does this decision give me more options in the future or fewer options? A massive mortgage on a specialized property? That's fewer options. A huge pile of cash savings? That's more options. This is why building up your room for error is so critical. That buffer, that cash that seems inefficient, is actually your freedom fund. It's the money that lets your 35-year-old self-change careers without blowing up your 22-year-old's investments. Second, you have to avoid the sunk cost fallacy. Just because you spent 10 years and a fortune becoming a lawyer doesn't mean you have to be a miserable lawyer for the next 30 years. Those 10 years are a sunk cost. They're gone. Don't let a past you barely remember dictate the happiness of a future you haven't even met yet. A reasonable plan knows when it's time to cut your losses and pivot. And third, stop thinking in all-or-nothing terms. Life isn't a choice between an 80-hour work week and being unemployed. Your portfolio isn't a choice between 100% stocks or 100% cash. The reasonable, sustainable path is always in the middle. A 60/40 portfolio, for example, is a portfolio built for change. That 40% in bonds is the buffer that lets you pull money out to start a new business without having to sell all your stocks in the middle of a bear market. The big takeaway here is this: we are all planning for a stranger. The person you will be in 20 years is a stranger to you today, so you have to be very careful with the chains you give them. Your long-term plan shouldn't be a rigid, concrete roadmap. It should be a compass. It should just point north towards being secure, independent, and free. The actual path you take to get there will change. In fact, it should change. So build a plan that allows for that change. Build a plan that gives your future, stranger self, the greatest gift of all: options. Chapter 15. Nothing is free. In our last chapter, we talked about a strange idea. We're all planning our finances for a stranger. That stranger is our future self, a person whose wants, needs, and dreams will inevitably change over time. Because of this, we realize we need to build flexible, reasonable plans. Plans with room for error, plans that value freedom, and most importantly, plans that lean on the incredible power of compounding. But let's be honest for a second. All of these things, saving money diligently, being patient for years, holding cash while others are getting rich, and especially enduring the sheer chaos of the stock market, they all feel hard. They don't feel easy, they're not free. And that right there is the entire point of what we're talking about today. Nothing worth having is free. Every single financial goal, even the smartest ones like letting your money compound, has a price. It's not some secret hidden cost. It's written right there on the price tag. The problem is, we often pretend it's not there. We see the prize but ignore the price of admission. Understanding this one concept is the real secret to staying in the game long enough to win. So, let's dive into one of the most powerful mental shifts you can ever make when it comes to money. It's learning the difference between a fee and a fine. Think about it. A fine is a punishment. It's what you pay for doing something wrong, like getting a speeding ticket. When you get a fine, your gut reaction is to say, "Ouch, that was a mistake. I'm never doing that again." You change your behavior to avoid the punishment in the future. A fee, on the other hand, is completely different. A fee is simply a price. It's what you willingly pay for something you want. You want to go to the movies, you pay the fee for the ticket. You want to visit a national park, you pay the entrance fee. It's a straightforward transaction. You pay the price to get the experience. Here's where it all goes wrong in our financial lives. We constantly, and often disastrously, mistake financial fees for fines. We see the price of investing and think it's a punishment for being in the market. Let's make this crystal clear with a real-world story. The product we all want from investing is the magic of compounding. We want those amazing long-term average annual returns from the stock market. It's arguably the greatest wealth-building ride in the financial world. But that incredible ride has a fee. And the fee isn't paid in dollars and cents on a monthly statement. The fee is volatility, it's fear. It's uncertainty, doubt, and chaos. The fee is watching your net worth get sliced down and having the guts not to flinch. Now let's rewind the clock to March of 2020. The world is grinding to a halt. Panic is everywhere. The S&P 500, a benchmark for the entire stock market, plummets by 30% in just a matter of days. It felt like a financial bloodbath. In that moment, let's imagine two different investors watching their portfolios crumble. Investor number one sees a fine, their brain is screaming, "This is a fine. I'm being punished for being in the market. I did something wrong, this is a disaster, I have to make the pain stop. Get me out." And so, what do? They sell. They sell everything, right at the bottom of the crash, just to stop the bleeding and avoid what feels like a punishment. They've confused the price of admission with a fine for bad behavior. Now let's look at investor number two. They see the exact same 30% drop, but they see a fee. Their brain says, "Oh, okay, this is it. This is the fee." They think, "I've just had 10 years of incredible growth. This gut-wrenching, terrifying moment of panic. This is the price of admission. This is the cost of getting those great returns. I knew this day would come, it was always part of the deal. I will now pay the fee." So what do? They do nothing. They hold on. Or if they're really embracing the concept, they might even buy more since the market is now on sale. What happened next? The stock market staged one of the most violent, spectacular, and rapid recoveries in all of history. Investor number two, who understood the fee and paid it, captured all of that incredible rebound. Their portfolio recovered and then soared to new all-time highs. Investor number one, who tried to avoid the fee by running away, did the worst thing possible. They locked in their losses permanently and likely missed out on the entire recovery, waiting for a safe time to get back in that never felt quite right. Once you understand this fee versus fine framework, you start to see it everywhere in finance. Every good, effective financial strategy has a price tag attached. The key isn't to find a strategy with no price, that's a fantasy. The key is to know the price in advance and be willing to pay it when the bill comes due. Let's look at a few examples. You want the magic of compounding. To turn a little bit of money into a lot over time. The fee is time. We're not talking months. We're talking decades of patience. It's also surviving that gut-wrenching volatility we just talked about. That's the fee. What about owning a simple, low-cost index fund that's designed to give you the market's average return? The fee is that you have to own every single stock in that index, including the terrible ones. The duds, the failures, the companies that go bankrupt. You don't get to just pick the winners like Apple and Amazon. You have to own the losers too. That's the price of admission for diversification and capturing the market's overall growth. Okay, what about the opposite? What if you want the total safety and peace of mind of keeping a lot of your money in cash savings? That seems free, right? Wrong. There's a fee for that too. The fee is losing purchasing power to inflation every single year. That cash might feel safe, but it's quietly losing 2, 3, or even 4% of its value annually. That's the price you pay for stability and having that money available at a moment's notice. The real scandals in finance aren't when markets go down or when strategies have a cost. The real scandal is when people are led to believe or convince themselves that they can get the reward without ever having to pay the fee. It doesn't work that way. There is no such thing as a free lunch, so here's the big takeaway for today. Stop looking for a financial strategy that doesn't have a downside or a price. It simply does not exist. Your goal should be different. Your goal is to find the price you're willing to pay. Find the strategy whose fee you can emotionally and psychologically handle. If you know deep down that you cannot stomach the fee of a 50% market drop without panicking, then you shouldn't be 100% in stocks. That's okay. It means you should have more bonds or more cash. You'll pay the fee of lower long-term returns, but you'll be able to sleep at night and, most importantly, you'll be able to stick with your plan. And that's the ultimate goal. The goal is to find a strategy whose fee you can tolerate, so that you can stay invested, stay on course, and let the incredible power of compounding work its magic for the longest possible time. Find the fee you're willing to pay, and you'll be well on your way. Thanks so much for watching. If this helped you think about your own financial journey, I'd appreciate it if you'd like the video and subscribe for more. Chapter 16. You and Me. Today, we're diving into one of the most common yet invisible dangers in investing. It's a trap that costs people their life savings, and it's something you absolutely need to understand. The core problem is this. We often take financial advice from people who are playing a completely different game than we are. To really get this, let's imagine two different investors. We'll call them you and me. First, let's talk about me. I'm a day trader. This isn't a hobby, it's my job. I'm a short-term speculator. My time horizon isn't years or decades. It's minutes, maybe hours, sometimes a day. My goal is simple. I'm chasing momentum. I don't care about a company's 10-year plan or its long-term fundamentals. All I care about is whether the stock price will go up in the next 30 minutes. I'm playing with capital that I'm prepared to lose. It's risk capital. It's a fast-paced game of speculation. Now let's talk about you. You are a long-term investor. This isn't just a game for you, this is your future. You're a long-term accumulator. Your time horizon isn't minutes, it's decades. We're talking 10, 20, even 40 years down the line. Your goal is completely different. You care about the slow, steady power of compounding. You care about survival in the market, making sure your nest egg is protected. Ultimately, you're investing for freedom, for a secure retirement. You're not playing with risk capital. You're playing with your life savings. See the difference? We're both in the market, but our worlds are polar opposites. Now, here's where the trouble starts. Let's say we both decide to buy the same stock. It could be Apple, Tesla, anything. We both click the buy button. But our reasons for doing so are on opposite ends of the universe. I'm buying because I see a quick upward trend I can ride for a few hours. You're buying because you believe in the company's vision for the next 20 years. We are not playing the same game. And when you forget that, things can get very dangerous. So how does this difference in games lead to financial disaster? The problem begins when you, the long-term investor, start listening to me, the day trader. This is precisely how financial bubbles are born. The author Morgan Housel argues that bubbles aren't just about greed. They form when long-term investors, who should be playing the slow game of compounding, start taking their cues from short-term traders playing the fast game of momentum. Let's look at a recent example like the GameStop or AMC frenzy. It's a perfect case study. It starts with phase 1. The day traders jump in. That's me and my crew. We see the momentum building. We're on Reddit, we see the hype, and we see a chance for a short-term gamble. It's our game and we're good at it. The price starts to explode, then comes phase 2. You, the long-term investor, are at home, responsibly putting money into your 401k or a broad index fund. You're doing everything right for your 30-year plan. But then you turn on the news, and you see stories about people getting rich overnight on GameStop. You see the day traders making a fortune. Suddenly, your boring index fund that goes up a little each year feels slow and stupid. This leads to phase 3, the infection. You get a massive case of FOMO, the fear of missing out. You see the rocket ship taking off and you feel like you're being left behind. So you abandon your 30-year game to play my 30-minute game? You take money that was meant for your retirement, your life savings, and you buy GameStop right at the very peak of the frenzy. And that brings us to phase 4, the crash. Me, the day trader, was always playing a short-term game. I was never in it for the long haul. I see the momentum fading. I sell my shares and I walk away with my profits. The bubble bursts and the price plummets. So who gets destroyed in this scenario? It's not me, the day trader. I was just playing my game and I played it by my rules. It's you who gets destroyed, the long-term investor. You got suckered into playing a game you didn't understand with money you couldn't afford to lose, all because you took your cues from someone who wasn't playing your game. You brought a 40-year plan to a 40-minute battle, and the result was catastrophic. This brings us to the most important takeaway of this entire video. This single idea will save you more money than any hot stock tip ever could. Before you take any piece of financial advice, whether it's from me on YouTube, a friend at a barbecue, or a so-called guru on TikTok or TV, you must stop and ask yourself 2 simple but powerful questions. First, what game is that person playing? Seriously, figure it out. Are they a day trader looking for a quick flip? Are they a retiree who has been investing for 30 years and is now focused on capital preservation? Are they a real estate flipper? Or, and this is a big one, are they a salesperson? Is this a financial advisor earning a commission or a crypto promoter getting paid to pump a coin? Their game dictates their advice. The second question is just as important. What game am I playing? Be honest with yourself. Are you saving for a down payment on a house in 2 years? If so, your time horizon is short and your risk tolerance should be low. Are you saving for retirement in 30 years? Then your time horizon is long and you can afford to think differently. Or are you just gambling because you're bored and want some excitement? That's a different game entirely, and you should only be playing it with money you are truly okay with losing. If the games don't match up, if the time horizons are different, then that advice is not for you. It might not even be bad advice in a vacuum. It might be perfectly good advice for the person giving it. But for you, it's dangerously irrelevant. It's like getting marathon training tips when you're preparing for a 100-meter sprint. So please, stop taking your financial cues from people who are not playing the same game as you. Define your own game, understand your own time horizon, and stick to it. That is the true path to long-term financial success. Chapter 17. The Seduction of Pessimism. In our last chapter, we learned a powerful lesson. Ignore people playing a different game than you. We decided to play our own long-term game. And we know rationally that the long-term game is one of optimism. We know compounding is a miracle. We know that, historically, the market always goes up over 20-year periods, so why doesn't it feel that way? Why do we live in a constant state of fear? Why does a single bad headline about a recession feel more real, more urgent, and more powerful than 100 years of positive economic data? Why is pessimism so much more seductive and so much more persuasive than optimism? The first reason pessimism is so seductive is because of speed. Optimism is a slow story. Growth is a project of decades. Compounding is a force so slow, it's practically invisible for the first 20 years. Good news is built. It's a series of small, boring, positive events that no one ever reports on. Pessimism, on the other hand, is a fast story. Destruction is an event of seconds. A market crash, a war, a pandemic, a surprise, these things happen instantly. Bad news is a threat. And threats demand our immediate attention. You see, your brain is not wired for the stock market. It's wired for the Serengeti. It's an ancient survival mechanism. Think about it. The caveman who ignored the optimistic sunset was totally fine. But the caveman who ignored the pessimistic rustle in the bushes was eaten. We are the descendants of the paranoid survivors. Your brain is designed to react 1,000 times more strongly to a threat pessimism than to an opportunity optimism. But there's a second reason, and it's even more powerful. Pessimism just sounds smarter. Let's do a quick experiment. Imagine two people. The first person, the optimist, says, "Don't worry. Everything's going to be fine. The market always goes up. Just buy. Technology will solve all our problems." How does that sound? A bit like a naive salesperson, right? Like they're trying to sell you something. Now listen to the second person, the pessimist. They say, actually, if you look at the sovereign debt to GDP ratio, combined with the inverted yield curve and geopolitical instability, the entire system is a house of cards. It is far more fragile than you think. How does this person sound? They sound brilliant. They sound intellectual. They sound like they've seen a truth that you haven't. This is the trap. Optimism is often dismissed because it looks like you're ignoring risk. Pessimism, on the other hand, sounds like it has already processed the risk. It sounds like critical thinking. The pessimist story is just more interesting. As Morgan Housel says, for reasons I've never understood, people like to hear that the world is going to hell. This ancient psychological bias has been weaponized by the modern world. The 24/7 news cycle and your social media feed are pessimism factories. If it bleeds, it leads. This isn't some media conspiracy, it's a business model. The news is not in the information business, they are in the attention business. And they know that your brain is hardwired to click on the threat, the pessimism, not the opportunity, the optimism. So every single day you are fed a constant, high-speed diet of the single worst things happening on Earth right now. This proves your bias. It confirms your fear. It makes pessimism feel rational. So what's the solution? Just be a blind, naive optimist. No, that's just as dangerous. The solution is to become a rational optimist. A rational optimist is someone who understands that the short term will always be a chaotic, terrifying mess. That chaos is the fee for admission into the market. A rational optimist understands that recessions, crashes, pandemics, and wars are not a sign that the game is over. They are a normal, recurring, inevitable part of the game. They are the fee you pay to capture the long-term prize. And what is that long-term prize? It's optimism. It's the rational belief that over a 20 or 40-year period, compounding will work its magic. The tails will drive growth, and humanity will, as it has for 200 years, slowly, brick by brick, build a more prosperous world. The takeaway is this: be a pessimist in the short run, but an optimist in the long run. Survive the pessimism to win with the optimism. Chapter 18, When You'll Believe Anything. In our last chapter, we talked about why we're so hooked on bad news, why we're seduced by pessimism. It's because we're hardwired to believe the scary story. But that brings up a much bigger question: why are stories so powerful in the first place? Why, in a world that supposedly runs on data, spreadsheets, and rational facts, does a simple, compelling story always win? It's because when the world feels chaotic and confusing, the only thing we have to hold on to is a good story. And what we're going to explore today is perhaps the most powerful and most dangerous force in all of economics: the power of a story you desperately want to be true. Let's start with a fundamental truth about how you operate. You are not a spreadsheet. You are a story processor. When we try to understand the world, especially the future, our data is always incomplete. There are massive gaps in our knowledge. Think about the big questions we constantly ask ourselves. What's the economy going to do next year? Will this new technology really change the world? Is this investment I'm considering actually a good idea? Each of these questions reveals a huge gap in what we know for certain, and your brain absolutely hates these gaps. It despises uncertainty, so what does it do to cope? It doesn't go looking for more data points. No, it finds a story. It finds a compelling narrative to fill that empty space, to make sense of the unknown. Think about it. A spreadsheet is just data. It's cold, it's hard, it's often confusing and overwhelming, but a story provides meaning. It's simple, it's emotional, and it's incredibly powerful. So when you're presented with both, which one do you think your brain is going to latch onto? Every single time we choose the story, even if the data flat out contradicts it. This isn't some small, insignificant flaw in our thinking. This is the very engine that creates every single financial bubble in history. To see how this works in the real world, let's take a trip back to 2021, the year of the everything bubble. We're talking meme stocks, crypto, NFTs, the works. Let's break it down by looking at the data versus the story. First, the data. The objective facts were frankly insane. You had people paying $3 million for a JPEG file of a bored-looking ape. You had people piling money into a digital coin that was literally created as a joke, based on a dog meme. You had people buying stock in a failing, brick-and-mortar video game store at a price that was 100 times its actual business value. From a purely rational perspective, the data made absolutely no sense. It was illogical. But then, there was the story. And the story was one of the best ever told in the history of finance. The music swells, it becomes epic, revolutionary. The story wasn't, hey, buy this JGAG. No, the story was, this is a revolution. The story was, we are building a new, decentralized world where the little guy finally wins. We are fighting back against the corrupt Wall Street bankers. We are creating the future of art, the future of finance, the future of community. This is the next internet. And the best part, we're all gonna make it. This story was so good. It was so hopeful, so compelling, so electrifying, that the data just didn't matter anymore. Nobody believed they were just buying a JB. They believed they were buying a ticket to the revolution. They believed they were getting in on the ground floor of the future. And that is the moment when you'll believe anything. It's when a story is so good. It makes you feel like you are part of something bigger than yourself, and suddenly, the facts become a minor, inconvenient detail that you're happy to ignore. This leads us to the psychological trap that ensnares so many people. It's a simple but powerful principle. The more you want a story to be true, the less you will question it. In psychology, this is related to outcome bias. We look at a story, and if we really like the potential outcome, like, I get rich, or I'm part of the future, We will believe almost anything that seems to lead to that outcome. The story of the 2021 bubble was a masterclass in this. It hit three of our most powerful and primitive human desires all at once. First, greed. This will make you rich and it will happen fast. Second, belonging. You will be part of a new, smart, exclusive in-group, WAGMI. And third, hope. This will fix the broken, unfair old system that has held you down. When a story hits just one of those emotional buttons, it's powerful. But when it hits all three simultaneously, it becomes an unstoppable force. A force that can create trillions of dollars in imaginary value out of thin air, right before it all comes crashing down. So, how do we protect ourselves from this? We're all human. We're all wired to love and respond to good stories. It's part of who we are. The antidote isn't to become a robot devoid of emotion. The antidote is humility. It's the ability to find the pause button in your own mind. The next time you feel that rush, that excitement, that tingling feeling of this is it, this is the next big thing, I want you to just stop, take a breath, and ask yourself one simple, crucial question. Do I believe this because the data is strong? Or because I really, really want the story to be true? Be honest with yourself. If the answer is, wow, I really want this story to be true, that's your red alert. That's the signal. That's the moment where your natural skepticism has failed you and your tendency to believe anything has taken over. The better the story, the more captivating it is, the more skeptical you have to become. Because in the world of finance and investing, the 5 most dangerous words you will ever hear are, this time it's different. Chapter 19. All together now. All right, we've reached the end of our journey through the psychology of money. This isn't a new chapter with a new story. This is the grand summary, the cheat sheet. This is where Morgan Housel ties everything together, boiling down all the complex psychology we've discussed into a handful of simple universal truths. Think of these as the core rules for governing your financial life, the ultimate takeaway from this entire book. First, and most importantly, humility. This is the foundation for everything else. It's the simple, honest acceptance that the world is far bigger, more complex, and more chaotic than your own personal experience can ever capture. It's about deeply respecting the incredible power of luck and risk that we talked about way back in Chapter 2. It's knowing that surprises, as we learned in Chapter 12, are not the exception to the rule. They are the rule. The unexpected is guaranteed to happen. So what does this humility look like in practice? It looks like building in room for error. The concept from Chapter 13. It means creating a financial buffer. Not because you're expecting one specific bad thing to happen, like a job loss or a market crash, but because you know you can't possibly predict all the different bad things that could happen. It's an admission that you don't know what the future holds. And that's okay. This humility is your first line of defense. Second, master your defense. In finance and in life, we are completely obsessed with offense. We're always chasing the next hot stock, the next big thing, the next tail event that will make us rich overnight. But as we learned in the crucial chapter on getting wealthy versus staying wealthy, survival is the only skill that truly matters in the long run. Genius can be fragile. A single mistake can wipe it all out. But endurance, the ability to stick around through thick and thin, is unbreakable. So, how do you endure? You save money. It's that simple, unsexy advice from Chapter 10. By saving, you build a life that is financially unbreakable. You create a foundation so strong that you are never, ever forced to sell your assets in a panic during a downturn. This is the only way to let the unstoppable force of compounding work its magic over decades. Staying in the game is the whole game. Defense isn't just about preventing losses. It's about enabling gains. Third, define your real goal. Seriously, why are you even doing any of this? The world, the media, and social media will constantly try to sell you on the rich man's game. They'll flash the Ferraris, the mansions, the extravagant lifestyles, and tell you that's the prize. You must learn to reject this. The real goal, the true prize we discovered back in Chapter 7 is freedom. It's the ultimate dividend. It's the ability to control your own time. It's waking up in the morning and saying, I can do whatever I want today. That is true wealth. And how do you achieve this freedom? By internalizing the lesson that wealth is what you don't see. It's not the car you drive or the watch you wear. It's the money you didn't spend. It's the assets you have, quietly compounding in the background. It's the room for error you built. It's that buffer that gives you options, flexibility, and control over your own destiny. Visible wealth is just spent money. True wealth is the financial security that grants you freedom. Those were the big foundational ideas. Now let's talk about the actionable mindset you need to actually execute them. This is how you put theory into practice. Fourth, be reasonable, not rational. This was the core message of Chapter 11. You are not a spreadsheet. You are a human being with fears, emotions, and biases. A financial plan that is 100% mathematically rational and optimized on paper, but causes you to panic and sell at the worst possible time, is a terrible plan. It's useless. The reasonable plan, the one that's maybe just good enough, but that you can actually stick with through thick and thin, is the plan that will ultimately win. So, do what helps you sleep at night. If paying off your mortgage early, even though the math says you could earn more in the market, gives you peace of mind, then do it. If holding some cash, even when you know it's technically losing to inflation, helps you feel secure, that's a perfectly reasonable choice. Your behavior is more important than your spreadsheets. Fifth, play your own game. This was the powerful lesson from Chapter 16. You have to stop taking financial cues from people who are not playing the same game as you. Don't let a 22-year-old day trader on TikTok influence you, a 45-year-old saving for retirement. Their goals are not your goals. Their risk tolerance is not your risk tolerance. Their time horizon is definitely not your time horizon. When you start blurring those lines, when you start copying the strategies of people playing a different game, that's when you get caught up in bubbles, make terrible decisions, and get ruined. Know your own goals and your own timeline and tune out the noise. And finally, sixth, your plan must be flexible. Why? Because as we learned in Chapter 14, you'll change. The person you are today is not the same person you were 10 years ago, and they will not be the person you are in 20 years. Your goals, values, and priorities will evolve. A rigid 40-year plan that locks you into a specific path is like building a cage for a future stranger. Your financial plan shouldn't be a GPS with a fixed, unchangeable route. It needs to be a compass. It should give you a general direction, but allow for course corrections as your life and your definition of happiness changes along the way. So, let's step back and look at the big picture. What does this all really mean? You've probably noticed something. None of these core rules were about what specific stock to pick. None of them were about how to perfectly time the market. None of them gave you a magic percentage you're supposed to save. And that is the entire point. This book, this entire journey is not a how-to guide for investing. It's a how-to-think guide for wealth and happiness. The psychology of money is not about numbers, charts, or formulas. It's about behavior. In the end, the person who wins with money is not the one with the highest IQ or the most complex financial models. It's the one who is the most humble, acknowledging they don't know it all. It's the one who is the most patient, letting time do the heavy lifting. And it's the one who is the most reasonable, choosing a good plan they can stick with over a perfect plan they'll abandon. The winner is simply the person who can master their own behavior. And that's a skill we can all learn. We finally made it. The last chapter. The grand finale. And Morgan Housel opens this final chapter by making one thing crystal clear. This is not advice. This is not a recommendation. This is just a confession. It's what he and his family do. He warns that you might disagree, that you might even think his plan is suboptimal. And that's exactly the point. He has built a life that works for him. And that is the only goal. So what is his goal? It's not to be rich. It's not a specific number. His number one, singular, non-negotiable financial goal is independence. It's freedom. He and his wife want to wake up every single morning and have 100% control over their time. They want the ability to say, I can do what I want, when I want, with who I want. That is their ultimate prize. And every single financial decision they make is run through that one filter. Does this purchase get us closer to independence or further away? So how do they actually achieve that independence? Let's get into the confessions. Confession 1, they save. A lot. Housel says they have a very high savings rate. But here's the key. They don't save for a specific thing. They're not saving for a new car. They're not saving for a bigger house. They save just to save. Why? Because they know that wealth is what you don't see. They know that every dollar they do and spend is a piece of their future freedom that they are buying back. It's room for error. It's a buffer for surprises. It's options. Every dollar saved is a tiny piece of a future where they are in control. Confession 2. Their investing is boring. Now, remember, Housel is a finance expert. He has access to all the complex theories and strategies. So, what does he do? Does he day trade? Does he try to pick the next hot stock? No, he puts his money into simple, low-cost index funds, and that's it. Why? Because he's not trying to beat the market. He's not playing that game. He is playing the long-term survival and compounding game. He just wants to capture the market's long-term returns, with the least amount of stress and the highest probability of actually sticking with it. It's the ultimate reasonable plan, not the most rational one. But this next part, this is my favorite part of the entire book. This is the confession that ties everything together. Morgan Housel paid off his mortgage. He had a 3% 30-year mortgage, and he paid it off early. Now, the little spreadsheet robot inside all of us is probably having a heart attack right now. What? You paid off 3% debt when you could be making 8% or more in the stock market? That's irrational. That's a dumb move. And you know what? Morgan Housel agrees. He says, I know, you're right. And he did it anyway. Why? Because his goal is not to be perfectly optimized. His goal is independence. And to him, the psychological value, the peace of mind, the freedom of knowing that the roof over his family's head belongs 100% to them, that was worth infinitely more than the 5% he lost in potential returns. He willingly and happily paid a fee for sleeping well at night. That is the entire book, in one single action. He chose to be reasonable rather than perfectly rational. His final confession is about his mindset. He and his wife are successful, but they attribute a huge part of that success to luck. Yes, they worked hard, but they also had the incredible luck to be born in the right country, at the right time, with the right opportunities. And because they know that luck played such a massive role on the way up, they are deeply aware that its evil twin, risk, can show up at any time, so what do? They hold a lot of cash. Way more than a rational person would. They are not optimized. They are unbreakable. They have built a room for error that is so wide that almost any surprise can come their way, and they will be fine. They have survived to win, and that is the end. That's the entire journey. What have we learned? We've learned that the most important part of your financial plan is you. Your flaws, your biases, your goals, your fears. The best financial plan is not the one with the highest returns on a spreadsheet. It's the one that is reasonable to you. It's the one that lets you sleep at night. Thank you so much for joining me on this 20-chapter journey. It has been an absolute privilege to explore this book with you. If you've been with us from the very beginning, I am truly grateful. The goal was never to give you answers. It was to give you a new way to think, a way to be kinder to yourself when you fail and more humble when you succeed. So go. Build your plan. Build it for your goals, not someone else's. Build it so you can sleep at night. Thank you for watching.